thanks for joining our rescheduled webinar on interest rates and inflation. My name is John Calverley, I'm Chief Economist. We also have Gerry Celaya here. James Chu, unfortunately, hello Gerry. Unfortunately, James probably won't be able to join us, or at least only maybe on a telephone, as he has an illness in the family to deal with. Apologies to those who attended the last seminar and we had to abandon it because of technical problems. Fingers crossed for today. But anyway, I'm going to speak first on the economy, particularly. Go to the next slide, please, Maxi. So I'm going to look at the question of how high will interest rates go and what will that do to the world economy. And then Gerry is going to look at the implications for investors and look at some of the charts. And then we'll have some questions at the end. So if you go to the next slide, please, Maxi. So when we look at what's happened over the COVID period, this is just showing GDP and in level terms. So the far left, it shows Q4 levels at 100. And you can see the big dip during COVID, the recovery. And we're now just about in the UK and Eurozone back where we started. And the US is just ahead. The US is ahead about 2.5%. That's not too bad over 2 years, 1.25% a year, but it's still relatively slow. But growth has been particularly strong over the last year or two coming out of COVID. It now seems to be slowing down. If we go to the next slide, please. Obviously, the big story is inflation. This is US personal consumer expenditure inflation, PCE, which is the one the Federal Reserve prefers because it tends to cover a wider range than the consumer price index. And you can see it spiked. You can also see just at the end there, it seems to have ticked down a little bit. And most people think, as we do, that it has now peaked. And one of the questions is, how quickly will it come down and how far will it come down? Here's the UK. This is the CPI, Consumer Price Index. We're up about 9% on the headline, and it's expected to hit 10%. We had the Eurozone today, and that's 8%, 8.1%. So inflation very high. A lot of that is food and energy. And of course, energy feeds into the core index as well, because everybody uses energy. But it's not just that. There is quite a widespread level of inflation. We go to the next slide, please. So this is showing the contributors to US inflation. And it's probably easiest to start at the bottom here. If you look at where it says energy goods. So the green bar is what energy should be adding to inflation if energy prices were rising at 2%. So it's about 0.1%. Energy, this is petroleum essentially for the US, gasoline. This is about 5% of spending in the US. So with 2% inflation, it contributes about 0.1%. But look at what it's actually contributed in the last year, over 2%, 2.2%. So a huge effect from petroleum. Second one up is shelter, which is essentially rents. And you can see rents are rising very fast. And this is actually a concern for inflation in the longer term, because rents are rising much more than 2%. And it's quite a big component of the index. Next one up is used vehicles. Because there weren't any new vehicles to buy, people were buying used. And it's the same in the UK. Prices are up dramatically. So you can see that's contributed about 0.9% to inflation over the last year, whereas it should be contributing again about 0.1%. Food at home, well, that's supermarket shop, again, nearly 1%. It should be about 0.2%. New vehicles, again, 0.5%, should be about 0.1%. Transport services, a lot of that's airfares in the US. Energy services, that's piped energy, essentially, so electricity and natural gas, again, a big contributor. And then food outside the home, in restaurants, etc., takeaways. So you can see that quite a lot of the inflation is actually coming from those particular fields. If you go to the next slide, please. This shows how much inflation could be reduced if all those sectors, food, energy, and used and new car prices, inflation slowed to 2%. So you'd save 2.1% on energy goods, about 0.8% on used vehicles, 0.7% food at home, and so on. And so you could actually cut inflation by 5.25 percentage points if inflation in those areas just went back to 2%, the target. Compare that with the April CPI, which was at 8.2%. So we'd get back to about 3% inflation if everything else stayed the same. Now, that may even be too pessimistic, because actually prices of energy could come down and prices of cars could come down, especially used vehicles. So it's quite possible that we'll have a period over the next year where inflation actually goes lower than it really is, or really underlying is, just because we get a negative effect on some of these special factors. Go to the next slide, please. The worry, though, is that inflation is really getting into the system, and the key there is wages. So this is the Atlanta Fed wage tracker, which is quite closely watched because it matches the same worker over a different period, rather than looking at average wages across the economy, which can be distorted by changes in the composition. And it's growing about 6%. And that's the highest level since this index started in 1998, much too high for comfort. It probably needs to be around about 3 to 4% in order for inflation to be at 2%. The difference, obviously, is productivity. So this needs to come down a lot. Go to the next slide, please. We see it also in the UK, where wage growth is rising, quite strong. There's quite a lot of noise in this indicator, again, composition effects going on. So it's probably not quite as bad as it looks here. Nevertheless, wage growth has accelerated and is pretty strong, and the Bank of England has big concerns about this. Next slide, please. So what actually drives wage inflation? Because this is going to be the key over the next couple of years or more. And there's a number of factors. First of all, the level of unemployment matters, and I'll show a chart on that, but also the pace of change of unemployment. And that's really down to the pace of economic growth. There are also structural factors that we will have to think about. Wage indexation used to be a problem in the 1970s, but it's very limited now. Might be coming back a little bit, but I doubt if that's a huge concern. Globalization, there's a big debate as to whether it's receding. Obviously, if you can easily offshore work, then people overseas can do it, and that puts pressure on wages on employees in the US or in the UK. Certainly in the UK, I think we've obviously retreated because of Brexit. So we've lost several 100,000 EU workers, and that's certainly a factor in the UK inflation situation. Unionization, again, back in the 70s, unionization was very high in both the US and the UK. It's pretty low now, so it's not so easy for unions to get together and get workers together and force wage increases. There's some signs that it's increasing under President Biden. The approach of the Democrats is to try to give labor unions more power. Maybe a factor, probably fairly small. Immigration has been very low in the US because of COVID, but also because of President Trump's restrictions, which have largely carried on through with President Biden, and it's low in the UK because of Brexit and also COVID. Immigration will probably pick up a little bit, but I doubt if that's going to be an important factor holding down wage growth. Arguably, it was very important in the UK until 2016 with the opening up to Eastern European labour. And then the final issue is labour force participation, which is still low, and I'll show you a chart on that one. Let's go to the next chart, please. So this is US unemployment. We're at 3.6% currently. We've got a data point out this week, likely to go to 3.5%. If it goes to 3.5%, that will be the lowest level, equal lowest level since the 1960s. Exactly the same level as we saw just before COVID. So the level of unemployment suggests wage growth could be strong. It's basically a very, very tight labour market. And if you go to the next slide, please. Here we see the change in unemployment. So this is the second thing that affects it. The red bars here are recessions. So obviously in a recession, unemployment goes up a lot, and in the recovery, it comes down a lot. We have had a very, very exaggerated cycle with COVID. In fact, it literally goes off the chart at the top and off the chart at the bottom. But still, even over the last year, you can see where the final point is there. The change in unemployment it's fallen basically faster than any time since 1982. So very rapid fall in unemployment. The Federal Reserve anticipates this will change. They're expecting unemployment to stay the same over the next year or so. We'll see, but that's going to be critical. If it goes up a little bit, if unemployment actually rises a little bit, that would certainly help to control inflation. The next slide, please. But as I said, very, very tight labor market. This is the number of job openings divided by the number unemployed. So essentially, there's 2 jobs available for every single person unemployed. And obviously that means that people feel very comfortable quitting their own job and moving to another job. It also means that people in a job can easily ask for a wage increase. So very, very tight labor market. If we go to the next slide, please. This is the labor participation rate. So it's the percent of the working age population that is either in a job or registered unemployed. And you can see that we're still down compared with pre-COVID. The same is true in the UK. These workers, some of them may be people who are afraid of COVID still, although that's probably fading. Some of them may be people who enjoyed working from home and don't want to go back to work. In some cases, it's maybe because of the aging population. So that people perhaps in the late 50s, early 60s are not so bothered about going back to work now. We don't really know where this is going to go. My guess is that especially as wages rise, people will be pulled back into the labor market, and that will help to tone down inflation somewhat, wage inflation. Next slide, please. So inflation should fall back, and the question is how much. This is the IMF inflation forecast to December. So it's December 2021, the actual, which for headline CPI was just over 7% in the US. And they're expecting that to go back to just over 5% by the end of this year, but back basically to target around 2% by the end of next year. The UK is an interesting one here because it'll actually be higher, most likely, at the end of this year than at the end of last year. And that's because there is a lag involved in UK inflation because of the energy price cap. So we had an increase in the cap in April. There's going to be another rise in the cap in October. So that's why inflation in the UK is essentially lagging what's happening in other countries. And the next slide, please. One reason for thinking that inflation will come down in the US is that the money supply growth is slowing significantly. You can see this huge spike in the money supply, M2, in the US in 2020. And this was caused by the policy of quantitative easing combined with big fiscal stimulus. But it's come right down. Year over year, it's running about 10%. Actually, over the last 6 months, it's almost flat. And generally speaking, when money growth slows, that implies that the economy will slow and inflation too. Next slide, please. But this is what's happened historically. Again, the red bars are the recessions. The blue line is inflation. You can see the spike at the end of the period here. And the dark blue line is the federal funds rate. So interest rates. And you can see that for most of the time, the federal funds rate is above the inflation rate. Usually the exception is at the very beginning of an economic recovery, just after the recession. Right now, of course, the federal funds rate is at 1%, and inflation, this is the PCE ex food and energy, about 6%, so well under. Now, that will come down, that PCE inflation, but historically, we've usually seen the federal funds rate go above it. So some people argue, therefore, that we need to have much higher interest rates, not just up to 2 or 3%. If you go to the next slide, please. So coming to my view on this, why we think the Fed's going to be less hawkish in the second half of the year. They've already said that they will likely raise rates by half point in the next meeting in June. And again, most likely in July, that will take them to 1.5%. Sorry, to 2%, 2 halves from 1%. So from there, I think they will go more slowly. And these are some of the reasons. So first of all, GDP growth is set to slow. I should clarify, as you may have known, the US did have a negative number in the first quarter. That was kind of an aberration due to exports and imports. If you looked at domestic demand, it was still quite strong. But I think there's signs already that things are slowing. Obviously, the higher prices for energy and other things simply impact spending power. Wages are simply not keeping up. Then we've got the stock market losses, and they're huge. In terms of trillions of dollars, there are accumulated COVID savings. People didn't spend all their money over 2020, 2021, but the stock market losses, at least on paper, are much higher. So that may slow things down. Another point is that the housing cycle is likely over, and this is something in the UK too. Because interest rates, mortgage rates are going up, we're already seeing activity, people looking for houses, people applying for mortgages, already slowing significantly. And that impacts the whole economy because it means that housing starts will slow, but it also means that there'll be less transactions. So people won't be buying appliances, they won't be doing renovations, etc., etc. So the housing cycle is usually one of the first to turn, and it looks like it's happening. And finally, investment could slow. In the US, investment's been quite strong coming out of COVID, not so much in the UK, but in the US it has. But with everything going on, the high inflation, rising interest rates, falling stock market, that suggests that business confidence may well waver. Now, at the moment, it seems to be pretty strong because a lot of companies, most companies, think they have very, very strong order books. I was at a meeting in Asheville in North Carolina the other day, meeting of about 30 economists, deliberately selected to come from different industry sectors, representing different companies. And the general mood there was that all their companies were behind on orders and were basically very confident over the next few months. But that could change, and I think it will start to change as we go into the second half. The other reason for being less hawkish is that I think headline inflation could fall back quite a lot. It's already started. If we see oil prices now stationary, big if obviously, because it depends on the Ukraine among other things, but if oil prices are stationary and if car prices don't go up more, you'll already start to see a significant decline. So if inflation, instead of being 6% or so on the core, is 5 and going towards 4, I think the Fed is going to think, okay, inflation's coming down, growth is slowing, we need to be a little bit cautious here. The next slide, please. This is what the market thinks. So this is the inflation expectations for 5 years forward. So it's the 5-year inflation rate essentially from 2027 to 2032, based on looking at different bond maturities. And you can see that although it's come up, it's still at about 2.3%. So it's pretty well behaved. The Federal Reserve will be quite confident about this, quite pleased about this. Now that's the market, of course, and the danger is that ordinary people are seeing price rises everywhere and don't agree with that and start pushing for wage increases. But as far as the market's concerned, they're reasonably confident. Next slide, please. So my conclusion on the first two questions, how high will interest rates go? We're at 1% now in the US, also in the UK. I think the federal funds rate will go to 2.5%, maybe 3% initially, but then I think they will pause. And this, I think this is going to play out over several years. It's not really going to be something over the next 6 to 12 months. I think the issue for the Fed is going to be that they will pause. They will find inflation going down because of some of those transitory negative effects I mentioned. But then the risk is that inflation is going up again in 2024, 2025 even. And then they may need to deal with that if they're still trying to get the 2% inflation target, which I think they will do. So what will it do to the world economy? Well, you're going to see quite a sharp slowdown, and there's obviously a risk of recession in this. We still give 50-50 to a soft landing, meaning avoiding a recession, essentially, just a period of slow growth. Might see unemployment rise a bit, but just the slower growth should be enough to pull inflation down. Certainly down to the 2 to 3% range initially. The danger is that we end up with it still at 3% in 2024. Next slide, please. So just a couple of slides on the markets here before I pass over to Gerry. When you get monetary tightening periods, as we do now, it's normal for bond yields to rise. And obviously US yields have risen about 1.25% this year. UK 10-year yields similar. That's pretty normal if you look at this chart. The grey The gray shaded areas is when the Fed tightens. We look at the next slide. And this is what happens to stocks. Now, this is interesting because in past periods, stocks have often sort of steadied. They haven't been rising very much. In the early 2000s, they did. And in the late 2010s, they did. So it's kind of a mixed picture. Obviously, this time, we've seen a significant decline in this period of Fed tightening, perhaps because valuations were stretched going into the period, and perhaps also because the Fed has been quite aggressive. The last time the Fed was so aggressive was in 1994. And you can see the stocks didn't go down, but they did certainly go sideways for quite some time there. So we've seen quite a big stock market adjustment. And if you go to the next slide, why the market sell-off, stock market sell-off? Well, the bonds were anticipating a tough Fed and a resilient economy, because the bond yield is still around 2.75% in the US, the 10-year. If the markets were anticipating a recession soon, that yield will go lower. So it's holding up there. So the expectation is still that the economy will remain resilient despite rising rates. But stocks have been facing this kind of perfect storm. You've got rising interest rates, both nominal and real rates. You've also got quantitative tightening coming through now. Nobody quite knows what effect that's going to have. That's basically taking bonds, putting bonds back into the market, getting them out of the Fed. So that can push interest rates up at the long end. There's obviously an increased risk of recession, even if people are not forecasting that. There's all the uncertainties over Ukraine still. That's in the background at the moment, but it's still there. And as I mentioned, you had high valuations, and I would say over exuberance in some sectors late in 2021. So that's what I had to say on the economics and sort of overview of the markets. Let me pass over to Gerry to talk about some detail on the markets.
Thank you, John. If we could move to the next slide, please. Thank you. That's beautiful. This is basically one of our our market returns tables. What we try to do here is provide some context to what John has been saying in terms of what's actually going on in the markets. One of the big calls that we've had at Tricio since probably the end of last year would be that the FTSE 100 would do pretty well, mostly because we like the idea of cyclical uplifts, and we were sticking with that even though it had been wrong in 2021. So it's one of those things where it's better to be lucky than be good, right, John? And so what we're looking here is that the FTSE 100 has held up okay this year relative to other indices, and we expect that to continue, mostly because it's the makeup of the index. It's got oils, it's got miners, it's got pharma, it's got a couple of financials that are heavyweights, but they're in the quote unquote the right region, so they're not going to get whipped around too much, mostly Asian exposure. And it's one of those things where it seems to be working for now. And the soft pound works in its favor because most of the earnings of the major FTSE 100 companies are in dollars, not in pounds. So people tend to be comfortable holding it on the expectation that after all the transactions are translated, you still make money holding it. Now, when you compare that to something like the NASDAQ 100, which is, like John was saying, one of the potential indices that grew too much in 2021, 2020, and the bounce back from after the March, April lows. And you've seen the NASDAQ 100 pretty much get whacked. It's down over 20% year to date. And that's just not a really healthy index for a lot of people. You have a lot of the names that we're all familiar with in terms of Tesla and things like that. And it's just one of those things where when people look at companies that may have gone too high, too fast, and are going to be pressured as real rates go up, the NASDAQ 100 seem to be bearing the brunt of investor negative sentiment. Now, if you go to the table just below this one, you have the bond market. And as John said, bond yields have adjusted sharply higher. So you have the US 10-year yield near 275, let's say, but that's still 120 basis points higher than it was at the start of the year. So that's a big move in bond markets. And you can see a similar thing in the German bond market and the Italian bond market, which, as we all know, is one of the biggest markets in Europe. That's even worse off at 180 basis points of rising in terms of the yield, which has widened the spread over the German Bund. Now, in terms of commodities, the big gains there have been in oil and the energy sector, as we know. And you've seen some tremendous year-to-date gains there. And this is part of the inflation picture that John has been talking about. Next slide, please. Now, this one we're looking at currencies, and one of the main things that has happened this year, which seems to have taken a lot of people by surprise, is the strength in the dollar. And we expect that to continue, but probably not at the same pace that we've seen in the first part of the year. In terms of credit, we've seen a lot of markdowns, and keep in mind that this is something that we think the Fed's going to be looking at as well, and not just the market. So if credit conditions tighten a lot, that's actually going to do a lot of good work for the Fed in terms of removing some of the excess liquidity. Now, in terms of the emerging market picture, one of the things we've done at Tricio is continue to say that, look, emerging market indices don't actually capture what you think they might be capturing. So for instance, the MSCI Emerging Market Index, as we all know, is 30% China and another 20% almost from Korea and Taiwan. So that's not really, in our view, emerging market per se. That's not the sort of risk that people may be thinking they're taking when they try to put money to work. So we also look at the ex-China index, and we look at other indices as well from individual countries. One of the ones that has stood out so far this year is, of course, Brazil. And that's the makeup of the stock index, which has a lot of mineral companies, oil companies, and the currency is appreciated as well on the dollar, which makes a year-to-date change even more remarkable. So it's one of those things where you have to pick and choose which emerging market risk you want to take. Next slide, please. And finally, these are the US sector breakdowns. What we do here is we try to gauge where the real strength is and the real weakness is, not just because we're trying to time cyclical things or trying to get the right, value versus gross idea, because we think for most investors, it's going to take them a while to adjust. And most of them, the target audience we have at Tricio is looking at 3 to 5 years. So it's one of those things where we look at this mostly to try to gauge sentiment and to see, what's really going on in the underbelly of the US market, if you will. One of the key things that stands out here is that while everybody's focused on the tech shares going down, consumer discretionary really, really got hit. That could be the makeup of the index. I mean, you have things like Tesla in there, which is, okay, it's consumer discretionary, but it used to be considered a tech share. So it's one of those things where you've got to keep in mind of what's actually inside the index. The energy sector year to date has done very well. One of the things that's kind of surprising, though, is utilities has done pretty well on a relative basis as well. And that's because of the makeup of the index. It's one of those things where you have a lot of power providers in there who are doing okay, even though when I went to school, it was all about as yields go up, utilities come under pressure. I don't know if that's a mantra you grew up with, John, but that's the sort of stuff that was, and the bonds and utility relationship was pretty strongly correlated. That hasn't been the case so far this year. Next slide, please. So let's look at the chart. The reason we're looking at this chart is it's a US 10-year note yield, and the red line on the top part of the chart is around 3.25, and that's a peak that we saw in 2018. Our view is, and it has been, that as bond yields would approach 3% to maybe 3.5%, we would think bonds are probably better held in your portfolio than not. To put this in easy terms, we were underweight in our view on bonds up until we started knocking at 3% in the US, in which case it was a month ago, we made the call that we had to basically move our underweight asset allocation weighting to a neutral position, which seems to be okay for now. And our internal debate is, when do we go overweight? And chances are that's going to be nearer to 4% than current levels. But we are still monitoring this. In other words, as yields go higher, the potential reward for holding the bond is actually better, which kind of makes intuitive sense. But a lot of trend followers would disagree and say, hang on, you're going against a trend. The reason for that is we do think bonds have a very, very valuable part to play in a balanced portfolio. However, having said all that, the risk is once we get above 325, if we get above 325, which we anticipate, you may see another sharp surge in yields. So you might see 350 get knocked out, then 4%, 425. And going against a trend, we would be saying, you actually might want to be going overweight in bonds here. Next slide, please. Now, commodities. This is one of those things where people always say, on a long-term basis, high prices will cure high prices. In other words, people will actually put grain to work, people will actually drill more wells, people will actually cut down more trees over time. So in other words, it's a very cyclical market, and right now we're in a strong upcycle. The danger, of course, is trying to say this is the top and leaning against it hard, because as you can see from the chart, commodity prices can trend higher longer than it makes a lot of sense. So that's more or less the stance we've taken now, which is, yep, commodity prices rising ever since we broke above that 200 level, which is the red line and the bottom of the bottom red line. It's been one of those markets that has gone steadily one way. And there's no real reason to think that things are going to get better in the short term. However, medium term, even with Russia making war in Ukraine, even with oil supplies being constrained, potentially gas supplies being constrained, and the inability to get wheat out the way we used to out of Ukraine to sell in the global markets, people will adjust. They'll start planting wheat where they didn't plant wheat before. Food manufacturers will switch to different products. And we've had lots of cycles where it looked like prices could only go one way, but in fact, they're reversed. So we anticipate that to happen this time as well on a long-term basis. Next slide, please. Now, we're focusing on oil because, as John mentioned, oil is basically the driver of a lot of the inflationary trends in the US and around the world right now. Now, keep in mind, old school again, oil price rises since maybe the 80s have always been seen as being a restraint on growth rather than just pure inflationary impact. So while we look at oil price rises going up and we think, okay, that'll feed through in higher inflation, it also has an effect of basically saying growth is going to slow down because people just don't have the money to drive 16 miles to go to McDonald's or whatever it is they do, right? So it's one of those things where we look at this and we're saying, yep, there's a lot of pressure here in terms of technicals. You have the $147 per barrel high that we saw back in 2008. That's one of the levels that we're looking at. If that starts to give way, then oil traders are going to be thinking $200 a barrel, all sorts of numbers, right? But over time, people will drill. You'll have oil, more oil pumps off the coast of California. Texas is already awash with oil, so is Oklahoma. And they might reopen tapped wells and just basically do more. Here, closer to home, the North Sea all of a sudden looks a heck of a lot more attractive with oil prices above 80. And the break even here generally is thought to be around 60, $65 a barrel. We're nearly double that now. So it's one of those things where a lot of projects that may be on hold or maybe they were thinking about winding things down will basically pick up again. So in other words, oil price pressures are really high right now. Unless we break above the $147, $150 per barrel area, we would expect oil prices to come down back towards the 90 zone and then maybe lower. Next chart, please. Wheat futures. This is not something we look at all the time. Yeah, that's, we'll say that right now. But we have looked at wheat in the past. And when I worked with John and James at American Express Bank, we always used to get requests from clients in the Middle East to look at grains and stuff. And I can tell you right now, it's a very difficult market to forecast with anything more than a couple of months leeway. But right now, when we look at this, we say, yes, we're at really high levels. Yes, we recognize the upside risk. But again, high prices cure high prices in the commodity markets. And this is one where I think we're probably closer to a peak than we are to an extension higher. Again, technically, the red line there is the 12-month moving average. And I would expect us to basically mean revert back to that by the end of the year. Next slide, please. This is what I mean about high prices cure high prices. These are the forward curves of both the oil and the wheat markets. And it's one of those things where you look at the forward curve, more or less you try to say, what are the professional traders and hedgers doing? Are they actually buying out along the curve to lock in high prices on the expectation that prices will be even higher? Or are they basically saying, look, we think prices will go lower in time? And at the moment, they're saying prices will go lower in time. Now, keep in mind that this is sort of backwards because it's one of those things where as you buy commodities in the future, you have storage costs. So in theory, you should be paying a higher premium because that should be reflected in it. But these curves are all sloping lower, which suggests the market is saying, nope, prices are going to drop further out. Next slide, please. When we look at frothy markets, though, the NASDAQ 100, I think, has been one of the frothier ones since basically the end of the global financial crisis in 2009. Now, this is a semi-log chart, which means that the scale is not an arithmetic one, but is rather a log, which gives you more of an indication of the percentage moves. And it's quite easy to see, and this is what we talked about at the end of last year and the beginning of this year when we had our other webinars, that the NASDAQ 100 is really frothy because it's trading outside of the top band of the channel. Now, it's come back into it, and we're looking at the 10,000 area as being very, very important support for us to hold on a medium to long-term basis. And we think it probably will. So we're not saying let's get back into this and, aim for new highs by the end of the summer, we are saying a lot of froth has come off this. And if markets adjust slowly to what the Fed is doing already, then there is a decent chance that the market will recover. Next slide, please. The S&P 500 shows a very similar pattern. Again, we talked about this at the end of last year and beginning of this year at previous webinars, where we said that this market was trading outside of the channel and there's plenty of scope for a correction lower, which is fine. We don't actually expect much damage below the 3,800 to 3,600 area in the S&P 500, but there is a risk we drop down towards the pre-pandemic highs, and that would put us down closer towards 3,400 and maybe then lower to the bottom of the channel. But I don't think it's what's happening right now. I think the froth came off and would probably recover back to the trend line, on the upper trend line, not the lower one. Next slide, please. Now, the Russell 2000, this is not the most perfect of indices, but it's still a reference point for US mid-cap sort of stocks. Now, this one, we've already seen a deep correction, and we are, basically at the pre-pandemic highs. And it's one of those things where when you're trying to gauge sentiment, you're looking for things that give you clues. And this is one of those that, okay, so the big gains of 2020 have been erased. The meandering gains of 2021, early 2021, have been retraced. Now what do we do? So either investors reload and say, yes, we still think, small cap / medium cap US shares have upside potential, or they don't. So we're watching this as a barometer. In my view, if we do start breaking below support substantially, then yeah, we'll have another 10 to 20% correction lower in the Russell, and that may drag sentiment down in the other indices as well. But here I'm looking at for to recover as well. Hopefully we'll see what happens over the summer as the Fed raises rates a few more times. And the next slide, please. Closer to home, FTSE 100 is holding up better than most. Now, we're not just showing this because we're very happy that we got lucky at the beginning of the year, end of last year, and saying that FTSE probably will do all right. Or maybe we are saying that, but it's one of those things where we look at the FTSE 100, and for 20 years, it's been a horrible index because basically it just made highs in 1999, and then it kind of meandered back and forth for a heck of a long time. That's the big green line, the 1999 highs. And while the US market zoomed higher in most of the major indices and other markets have done well, the FTSE 100 has not really shown very strongly for some time now. So is this a time? Are we going to see new all-time highs? I'm not sure. And the reason for that is, even though we like holding the FTSE 100 at the moment, and our asset allocation is very positive in the UK in general, I'm not sure we're going to race above 8,000 towards 8,500 anytime soon. So I think we'd be lucky here to hold on to current gains and probably press higher towards the all-time high near 7,900 or so. Maybe break to new all-time highs, but it's not something I'd be really betting on in the near term. But it should hold up. And ideally, we don't see much trading below 7,200, 7,000 to 6,800. Those would be warning signs if you start getting below there. If you have further questions, please feel free to email us at our own email addresses or at the info one here. We will be distributing the the slide deck to our webinar members and clients. And we will be putting up the video at a later date, and we'll alert everybody where it is. But on behalf of Tricio and James and John and our other colleagues, we'd like to say thank you for joining us, and we hope you make it to other webinars, and we hope you find this one useful. Okay, so bye for now, everybody. And John?
Yep. Bye, everybody. Thanks, Jerry.
Thank you.